Can diversification actually hurt you? Well, if we're talking about diversifying across food groups, and they're healthy food groups, it's not a bad idea. But a lot of people diversify this way when it comes to eating, and that is a bad idea. Now, same thing with investing. People often use different investment managers, different fund companies. They have an account with this firm and this firm over here, and they think, well, there's safety in numbers. This is a good idea. Well, multiple managers typically own the same stocks, so you end up with perceived diversification. So if I own this mutual fund over here and this one over here, my money isn't actually with that mutual fund company. They're just doing the accounting on it, so to speak, and the choosing of the investments, but they really don't have it. So if this fund company goes under, it doesn't really hurt me. Now, what happened in 2008 was this. In 2008, banks tried to diversify by packing a big group of mortgages into a bundle and turning them into investable bonds. Problem was, they diversified across the same asset category, which is subprime mortgages. And we all know how that turned out. Now, something we've seen in our firm over the years is this. People buy these precious metal funds or sector funds in technology, healthcare, and energy, and real estate, and they think this is a really good idea. But they didn't buy these things until after they did well. Wrong time to buy things. And then people are buying private equity right now thinking that's a good idea, and it's not a really good idea. Now, the other problem with multiple managers is this. You're missing cost breakpoints. When I have lots of really small accounts, I don't get the breakpoints I would have if I had a much larger account. Costs can go down when I have a larger account. Now, there's another problem. It's cognitive error. If you look in the late 90s, an investor, you'd be looking at this and going, wow, this is a really great area of the market right here. I ought to be putting my money in that area of the market. Now, the problem is if you were an investment manager and you had most of your clients' money in that area of the market, they would think you were a genius. And then you would have stuck with them or put all your money with them. And then what would have happened? That's where you would have been going forward. So you can end up with lots of problems with multiple managers and not understanding what's really going on.